All right, today we had a somewhat interesting introduction to S corporations and a planning type of a discussion, various issues, and not getting our feet wet 100% in an academic approach to it, which we'll do next Wednesday, where we'll go through how do you make the election to become an corporation, some of the details there, who's eligible, what are the rules of maintaining your status as an S corporation, things of that nature. Today I want to follow up on what we mentioned in class, and that is there is subchapter S in the code, so we'll say subchap S, which gives us all the rules and laws when dealing with S corporations. However, sometimes a particular transaction comes up and subchapter S doesn't address it. Here's a case where that concept occurs, where the default rule is, which we learn in class, the default rule is you then, in order to know what the answer is, you then go to the other chapter, or the other subchapter in the Internal Revenue Code where corporations are discussed, in subchapter C, which are C corporations. So what happens basically is the following. In a situation where a C corporation distributes property to its shareholders, makes a distribution of property to the shareholders, we learned that this is to be recognized under subchapter C as a deemed sale by the corporation, recognizing tax as if it was sold. The C corporation recognizes a deemed sale, pays the tax, even though the sale never happened, and then the shareholder picks up the property as if it was a distribution or dividend to them from a C corporation, and to the extent that there's retained earnings, they'll pay dividend income tax on the value of what they received, double taxation. In an S corporation, if we make a property distribution, we don't know what to do with that. Subchapter S doesn't describe it, and we wind up going to subchapter C, the default rule, to find out we treat it the same way. Wait a minute, something's wrong there. Isn't an S corporation a pass-through entity and it doesn't pay tax? All right, well that's true. So here's how it works, which will teach us not only the lesson of the default rule, but a little bit more about the workings of these S corporations. That doesn't look right. Pass through. Okay. All right. It's a pass through. S corporation is a pass through entity, and so it's not going to pay tax, but this will happen on the deemed sale. The S corporation will recognize the gain or loss. And let's talk in terms of a gain, so we really learned some interesting nuances here. There's a gain. Gain. And it's taxable, as it should be. And the result is that taxable gain, we then know what to do with under subchapter S, which is what? Now we compute the gain at the corporate level under subchapter C, where it says it's a deemed sale. If it's a deemed sale, and now we find out in subchapter S that it tells you what to do with a sale of an asset. What do we do with a sale of an asset under subchapter S? Well, we follow the rule. We pass it through. To whom? To the shareholders. So the shareholders will pay the tax on the gain, and we avoid double taxation, which is correct because, after all, it is a pass-through entity.